Hi everyone, welcome to Intermediate Financial Accounting 1. In today's class, we're going to talk about financial accounting and accounting standards and conceptual framework for financial reporting. Specifically, there are 4 topics we're going to cover in today's class. First of all, what is financial accounting and why do firms produce financial accounting information? And what are the accounting standards setting in the US? What is FASB's conceptual framework? And what are the 5 major financial statements? So first of all, let's start from talk about what is accounting. Accounting is a system that accumulates and processes information about an organization and report information to decision makers. So there are several keywords here. First of all, accounting is an information system. And that information system is to accumulate and process information and report information to decision makers. And who those decision makers are. So there can be several kinds of decision makers. Those can be the firm's internal decision makers. So which are mostly the firm's managers, the internal users of those information. And it can be external users or decision makers. And then it can be tax authorities. So all of those 3 kinds of decision makers need financial information in order to make good decisions. But they are also different. For the firm's internal users, as I just said, those are basically the firm's managers. And the external users, investors, and creditors. And you can possibly imagine some of the needs of those internal users can be different from the firm's external users. And also the tax authorities. So the need of tax authorities, the information need of tax authorities can also be different. So depending on who those internal, external tax authorities, depending on who those decision makers are, the way we prepare accounting information can be different. And as a result, we have different accounting system. If the purpose of the accounting system is to ultimately report information to the firm's internal users, that is called managerial accounting. If the purpose of the accounting information system is to ultimately report information to the firm's external users, that is called financial accounting. And if the purpose is to ultimately report information to tax authorities, that is called tax accounting. So you are probably taking or will take several accounting classes. And now you can see what are the major difference among those different accounting classes. It's mostly the major difference is who the information users are. And this is a financial accounting class. So as we just mentioned, what is the primary function of financial accounting? Yeah, it is to provide useful financial information to the firm's external users. And examples of those external users, those can be the firm's investors. It can also be the firm's creditors. So for those of you who don't know what investors and creditors are basically the firm's stockholder, and creditors are basically the firm's debt holder. So the firm's debt holder can either be those who bought the bond the firm's issue, or all those who lend money directly to the firm. So just talking about what is the primary function of financial accounting. Then let's look at what are the examples of financial accounting information that firms produce. One example is annual report to the firm's shareholder. And also the firm needs to file different SEC filings. So SEC stands for Securities and Exchange Commission. And for the typical SEC findings can be the firm's 10K report, 10Q report, and 8K report. And for those SEC findings, those are mandatory for publicly traded firms. So besides that, manager may also voluntarily make earnings forecasts and other disclosures, but those other disclosures are voluntary for the firm versus the SEC findings, those are mandatory for all publicly traded firms. So one of the major SEC findings here is called 10K report. I don't know how many of you have seen a 10K report before. Let's take a Starbucks 10K report as an example. So this is an example of Starbucks 2017 annual report. The annual report and 10K report, those are, in most of the case, you can see here, it is the firm's annual report and then it is from 10K. It can be the same thing. It can be a little bit different. Sometimes the firms will make its annual report look more colorful, but it's mostly the content should be almost the same. So 10K report is the form the firm files with SEC. An annual report, the firm may have an annual report, which is a more colorful one, which is actually both 10K report and annual report will be posted on the firm's website. So as you can see here, this is Starbucks 10K report. And whenever you look at a firm's 10K report, if you look at several firms' 10K report, you may notice that it is the basic format is pretty similar. So in the sense that the table of contents are they should be almost the same. So for example, part A, item one, part 1, item 1 is that it is called business. It is where the firm talk about its major business. And then another item is part 2, item 7. So that is MD&A. So in all of the 10K report, you should have a part 2, item 7, which is MD&A, which is management disclosure and analysis of the firm's financial conditions. And then in part 2, item 8, that is the financial statement. So let's go there to take a look. Yeah, so item 8, financial statement and supplement data. So as you can see here in this section, here are the firm's 5 major financial statements. So it's basically 5 pages. Those are in all this 10K report, it has probably around 100 pages. And then only 5 pages, those are the firm's financial statements. So as you can see here, the firm's 10K report includes a lot of the information that besides the firm's financial statement. It can be very informative if you look at it in depth. And then right after the firm's financial statement, this section is the notes to the financial statement. So it has 18 notes here. And as you can see here, the major items, most of the major items, the firm is putting those in notes. The firms actually, they're going to talk about what major accounting policies the firm use for each item. And sometimes they will give you breakdown for each of the item. So yeah, this is just to give you a brief idea how a 10K report looks like. And so we just looked at the 10K report, which is an example of something the firm produce. But why do firms produce those kind of financial accounting information? We have kind of already mentioned some of those. So it is required by regulator SEC in many cases. Users demand accounting information. Is there anything else? Yeah, so, but one of the ultimate use is to address information asymmetry issue. So what is information asymmetry? I don't know how many of you have learned it in your economics class, if you have taken any. What is information asymmetry? Please spend 1 minute, think about it. So information asymmetry is basically the asymmetry of information between two parties. And one example is like this. So just ask yourself, do you know anything that the other people do not know? We all know something that the other people do not know. For example, does any of you know what I ate for breakfast this morning? Right. And if you ask your group mates, does anyone know that when you did your last haircut? So those are just some small examples, but we all know something that the other people do not know. And this is called private information. And because of the existence of this private information, there is information asymmetry. This is basically the asymmetry of information between two parties because we know something that the other people do not know. So there's information asymmetry between us and the other people. Because I know I'm the only one who knows what I ate for breakfast. So there's information asymmetry between you and me regarding what I ate for breakfast. Because you are probably the only one among all of us who knows when you did your last haircut. So there's information asymmetry between you and all of us regarding when you did your last haircut. So because of the existence of this private information, there's information asymmetry everywhere, actually. So information asymmetry, it is not something special. It is existing everywhere. And so this information asymmetry, is it bad or is it good? Can it be a problem with information asymmetry? If so, when? First of all, is information asymmetry necessarily bad? So the answer is not necessarily. When there's no conflict of interest, the answer is no. There's no problem at all with information asymmetry. But when there is conflict of interest, that's when problem arise. So an example of that is Aklov's market for lemons, or it is called used car market. And this is, so Aklov, that's George Aklov. And George Aklov actually won the 2001 Nobel Prize for his market for lemons. So as a side note, this George Aklov is actually Janet Yellen's husband. So Janet Yellen is the new Secretary of Treasury. And she was also the previous Federal Reserve chairwoman. Yeah, so this is Very interesting couple. So what is this Aklof's market for lemons or used car market? Supposedly there are 10 cars on the market. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 cars on the market. Suppose that 7 of them are good cars and 3 of them are bad cars. Those good cars, we also give it another name. It is called, we call it peach. And the bad cars is called lemon. So if you do a Google and there's actually something you can Google that is called lemon car, which looks like this. So this is a lemon and car. So that is called a lemon car. Yeah, make it more like a lemon. So we have peach and we have 7 peach and 3 lemon cars. Suppose the good cars, they was $100 each. And the lemon cars, there was $30 each. So suppose the rule in this market is only the seller of the car know whether it's a good car or bad car. In other words, in this market, only the seller know the car it is selling, whether it is a lemon or whether it is a peach. And the buyers have no idea what kind of car they're buying. From the buyer's perspective, all those 10 cars, those are identical. So as a buyer, what do you think the price the buyer is willing to pay for each of those cars? So if you are a buyer, what price would you pay for those cars? Rationally speaking, if I'm a buyer, so there's 7% of the chance I will end up with a good car, and 30% of the chance I will end up with a bad car, right? So the price I'm willing to pay will be $79, right? So can you see the problem here? I will pause for 1 minute. Please take 1 minute. Think about in this kind of market, what can be the potential problem? So what do you think can be the potential problem here? If you are the seller of a good car, are you willing to sell in this market? Are you willing to sell in this market if you are the owner of a good car? So the answer is no, because you know that your car is worth $100, but someone is only willing to pay you 79 for your car. So you won't be willing to sell. However, if you're a bad car owner, would you be willing to sell on this market? Yes, the answer is yes, because you know that you have a lemon car which only worth $30 and someone is paying you 79. Oh, so I'm going to sell it. Yeah, of course I'm going to sell. So what can be the result? What can be the result of this? All good car sellers will be driven out of the market, right? So if you are the good car seller, you won't be willing to sell on this market. So you will like, okay, so I'm not going to sell. So I will withdraw. I'm not going to sell my car here. And then what will end up happening is all of the cars left on this market, there will be only the bad cars left. So is there going to be any market anymore? If the only car left on this market will be bad cars. So if you as a buyer know that the only car left on this market will be bad car, would you be willing to pay $79 for something which is only worth $30? Of course, no. So first of all of the good car sellers will withdraw. And then all of the buyers will withdraw. And then the only thing that is left on the market are bad cars with no buyer. So is there going to be any market anymore? No, there will be no market. So what will end up happening is there will be no market, or in other words, the market will collapse. So this is the consequence. This is actually the consequence of information asymmetry. The information asymmetry is here between the seller and the buyer, because only the seller. So as you can still possibly remember, which we mentioned 5 minutes ago, in this situation, there is information asymmetry between the buyer of the car and the seller of the car, because only the buyer knows whether the car it has is a good car. So if I'm the seller of car number 3, only I know whether it is a good car or bad car, and the buyer does not know. Because of this information asymmetry, so the ultimate consequence is there will be no market. So as you can see here, how important is this information asymmetry issue to the well-functioning of a market. And it is the similar story of from financing through the capital market. Just now we talked about the used car market. And here on the capital market, it is actually the same thing. Please spend 1 minute, think about why it is the same thing on the capital market. Why is it the same thing on the capital market? Suppose we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 firms, and only the firm itself know whether it is a good firm or bad firm. The investor do not know whether it is good firm or bad firm. So what will ultimately happen? What will ultimately happen is, because investors do not know whether it is good firm or bad firm, because of this information asymmetry between the firm itself and the investors. So investors won't be willing to pay the full price for a good firm. And then what will end up happening is all good firms will be driven out of the market. And what will happen next? If all of the good firms are driven out of the market, investors will withdraw as well. If all of the firms left on the market are bad firms, investors won't be willing to buy. So what will end up happening is there will be no market. So there will be a market collapse as well. So this is the consequence of information asymmetry. If there's an information asymmetry between the firm and investors, which is not properly addressed, investors will withdraw and there will be no market. The market will become very badly functioned. So what can we do to solve the information asymmetry problem? Yeah, one way we can address it is for the firms to disclose, but is the disclosure enough? The answer is no. The disclosure itself by itself is not enough. What else do we need? We need credible disclosures. So the disclosure should make sense. It should be credible. The firm cannot just disclose by itself. The firm, if it's not credible, it's still the effectiveness of those disclosures can still be very limited. So we need credible disclosures. But what can we do to make disclosure credible? Yeah, please spend 1 minute, think about what can we do to make those disclosures credible. one thing we can do is assurance from a credible third party. So that is what is happening actually. On the used car market, we have Carfax, we have certified cars. And on the capital market, we have auditors. Auditors are basically, those are third parties, which is to make disclosures credible.